Hey everyone, happy Thursday, September 26th. It's about 11 a.m. on the West Coast, and it's time for another market update. We got our first rate cut. We got a half point like we like, but mortgage rates really haven't responded like a lot of people thought they would. But like we've talked about, that's because mortgage rates had already started building that rate cut in as soon as they knew that was going to happen. So now that we're past that first rate cut, the markets are doing the same thing. They're starting to try to predict what's going to happen in the next Fed meeting coming up in November. So, between now and then, the most important thing is going to be anything inflation related, anything employment related, anything economy related, because we know the Fed is paying really close attention to all that kind of stuff. So, going into what we found out this week, we got, a monthly appreciation report. So the two biggest ones we look at are the FHFA and Case-Shiller. Case-Shiller includes everything. FHFA excludes jumbo loans and cash deals. This data is a little dated comparatively. It's from July, but both went to new all-time highs. But it's slowing down a little bit. So you can see here, this is Case-Shiller, both their 20 city, their 10 city, and their national index. National index is going up about 5% year over year right now as far as inflation, or I'm sorry, appreciation. You can see it tapped out way above, it looks about 20% up here. So this doesn't mean that your house is depreciating, this downward trend. This just means inflation or appreciation is decelerating. So it's still going up, just not up as fast as it was. Which again is okay as long as we want to see home prices go up for current homeowners, but we don't want to see this where it's just outpacing income and things like that. So that was Case-Shiller. Case-Shiller is still at 5%, up a month over month. So all good on that front. FHFA, same thing. It's up about 4.5% for the U.S. As you could see, the biggest gains here are in the Pacific and the mountain regions, where the rest of the country was kind of down a little bit. But Pacific and mountain up really good year over year. You can see the shaded one is 2022 through 2023 July. This orange one is July 2023 through 2024. So good to see the West Coast kind of popping those up. Which kind of jives with what we're seeing out there. So good overall for homeowners, not good for people that were hoping home prices would drop and they get, big old discounts on these homes they want to buy. And another thing to keep in mind is as rates drop, that will increase the demand for homes with more people in the market. That generally does not lead to prices going down. If anything, that would lead to prices going up. So just something to keep in mind there, but overall good for homeowners. Next thing, we got August new home sales. So those were down negative 4.7% month over month, but still exceeded expectations. Expectations were about 700,000 new units. These came at 716,000 new units. And remember, the month before this was really high. So that's why the month over month number is a little bit more of a negative. But again, still more supply needed. So the more they can build, the better. But even though it was a negative, it was still above expectations. They kind of expected a lower number for August. Next thing, August pending home sales. So these are homes that went pending in the month of August. So a lot of these people were maybe dealing with August rates, and we saw these come in at 0.6% increase. It was expected to be about a 0.3% increase, and year over year is still down 3%, but this number got a lot lower compared to last month. So again, it just kind of shows you that with mortgage rates coming down a little bit, more people basically jumped in and went pending in the month of August. So mortgage rates and activity are definitely linked. Next thing. So this is an important one. We got the final reading for Q2, the second quarter of the United States GDP. So this came in as estimated as the previous reading was at 3%. Again, the Fed's paying really close attention to this. The bigger this number is, the better the economy is doing, the more they can say, hey, we don't need to cut rates. The lower this number is, the more they might, think about cutting rates faster and more to stimulate the economy. So, not that we don't want to root for people to lose their jobs. We don't want to root for our economy to go into the tank and in recession. But if we want rates to come down faster, those are the kind of things we have to look out for. Next thing, initial jobless claims. So this number came in again lower than expectations, only 218,000 jobs or new unemployment claims. So again, this is important because the Fed's looking at this. Gives us an idea of newly unemployed people filing for benefits. There's some issues with these numbers, considering it's only initial claims. Continuing claims still is pretty elevated, but people drop off those continuing claims once they basically use all their benefits, and we don't track those people anymore. So there's probably quite a few people in that position. So again, very important to pay attention to because the Fed's looking at this. The higher number this is, the more we see these start to elevate. The Fed will pay attention, and that's kind of showing the job market's weakening. So again, a little bit lower number. So something, it's basically stayed pretty steady in this kind of 210 to 230 range for almost a year now, I believe. And again, continuing claims a little higher. So it seems like still people are trying to hold on their employees, but once someone does lose their job, it's a little bit harder to find one. Um, where does that leave us? So the average conventional last week was at 6.17. Today we're at 6.21. So a little bit of an uptick again. So it's getting the markets are kind of adjusting, selling off a little bit since that rate cut because we had dropped so much before, leading up to that day. And we didn't like, some of the stuff the Fed released, some of the stuff Fed said about future rate cuts. So again, that's what we got to keep our eye on. That's what the markets are looking at is what is going to happen coming up this Fed date of this November 7th. That's their next meeting. So between now and then, we get, tomorrow we're getting PCE, the Fed's favorite form of inflation. So that's the first market mover. That could change how people think, oh, this comes in a lot lower than expected. Awesome. We made good progress on inflation. Fed's going to cut maybe more. But if this number comes in higher than expected, then maybe the opposite. We get some negative repercussions. Same thing with his BLS jobs report next Friday. This number comes in low, unemployment goes up. Good thing for not unemployment going up. Again, not good for people overall, but it's good for mortgage rates. So those are the things we have to look at. We have to look at inflation, jobs, as we lead up to that November meeting. Overall, though, it's, things are heading in the right direction. We got that first rate cut. Like I said, right now it's about a 50% chance we get another half point at that November meeting, and then about a half point, their markets are figuring for that their last meeting of the year in December. So something we got to keep an eye on. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody.